Can a century-old energy titan surge ahead despite declining revenues and volatile commodity prices? We've dissected ConocoPhillips' latest moves, from their bold Marathon oil acquisition to surprising financial metrics that could signal a hidden growth story. In this video, we'll uncover insights that may reshape your investment perspective on this energy giant. Ready? Let's get freaky in those accounting sheets. ConocoPhillips, founded in 1917 and headquartered in Houston, Texas, is a global energy producer with a diverse asset portfolio. The company specializes in unconventional shale place formations, requiring advanced extraction techniques and oil sands projects in Canada. Its involvement in liquefied natural gas, which enables natural gas to be transported where pipelines aren't feasible, extends its global reach. This strategic diversification helps mitigate risks associated with regional market fluctuations. Examining the balance sheet, ConocoPhillips holds $5.22 billion in cash against $18.3 billion in debt as of September 30th, 2024. This results in a negative cash debt balance of $11.51 billion, indicating reliance on debt financing. However, a debt-to-equity ratio of 0.2 is considered prudent. It means the company has 20 cents of debt for every dollar of equity. Retained earnings have risen to $63.46 billion, reflecting strong profitability, while the upcoming Marathon oil acquisition will add $5. $3 billion in debt, management's plan for a $20 billion share repurchase over 3 years signals a commitment to enhancing shareholder value. Here's a screenshot of the full balance sheet. Total assets stand at $96.7 billion, marginally overshadowing liabilities of $46.8 billion. This asset-liability structure suggests a strong balance, providing a solid foundation for growth and resilience amidst market fluctuations. With our proprietary Bow score, ConocoPhillips excels in preferred stock, outperforming almost all industry peers. Its retained earnings to market cap is also strong, indicating solid profitability. However, cash minus debt is weak compared to peers, suggesting lower liquidity. Debt to equity is average within the industry. ConocoPhillips' recent income statement reveals a mixed financial picture. The gross margin improved slightly to 30.9%, indicating efficient production despite commodity price pressures. Notably, the operating income margin surged to 48.5%, suggesting strong operational control. However, the net income margin dipped to 15.1%, impacted by higher operating expenses in key segments like the lower 48 and Alaska. Management's focus on cost control has helped offset lower oil and gas prices. Flat EPS growth at 0% reflects external market challenges rather than internal issues, demonstrating resilience in a volatile environment. Here's a screenshot of the full income statement. The decrease in revenue from $14.3 billion to $13 billion may indicate challenges in sales performance, while stable production expenses reflect consistent operational management. Investors should assess how these factors compare to industry competitors for a clearer outlook. ConocoPhillips excels in SG&A and operating income margins, outperforming over 95% of the index, indicating strong operational efficiency. However, its EPS growth lags behind both industry and market averages, suggesting potential challenges in translating efficiency into earnings growth. ConocoPhillips' financials show a consistent decline in revenue and net income over the past year, from $14.64 billion in revenue and $3.01 billion in net income at the end of 2023. Revenue dipped to about $13.6 billion, and net income to $2.06 billion by the third quarter of 2024. This trend reflects lower oil and gas prices due to increased supply, despite higher production volumes. Ongoing price fluctuations, known as commodity price volatility, pose challenges, suggesting potential risks for investors considering the company's growth prospects. ConocoPhillips' free cash flow rose to $2.847 billion in September 2024, yielding 2.1%. This indicates strong operational efficiency and prudent capital management. The capital expenditure margin of 141.6% means the company generates significantly more cash than it spends on capital projects, a positive sign for investors. With no stock-based compensation expenses, management shows a conservative approach to shareholder equity, an operating cash flow margin of 33, 46% underscores robust cash generation. Despite fluctuating commodity prices, these factors position ConocoPhillips well to invest in growth and return value to shareholders. Here's a screenshot of the full cash flow statement. A noteworthy aspect is the $15.67 billion net cash from operating activities, suggesting strong core profitability. However, the $8.95 billion used in investing activities points to significant capital outlay, which needs careful evaluation against industry norms. ConocoPhillips delivered strong Q3 results, exceeding production forecasts with a record 1.147 million barrels of oil equivalent per day, driven by robust operations in the lower 48. They've modestly raised their full-year production outlook, reflecting operational confidence. The impending Marathon Oil acquisition is progressing, with expected cost savings or synergies now anticipated at $1 billion, enhancing potential profitability. Management acknowledges risks like commodity price volatility due to global factors like China's slowdown, but aims to sustain profitability with a low break-even price in the low dollar, 30s per barrel. A 34% dividend increase underscores their commitment to shareholder returns. Analysts forecast ConocoPhillips' net income reaching $12.1 billion by 2028, indicating steady growth amid rising energy demands. A projected EPS of $10.04 reflects optimism about profitability. EPS is crucial for assessing shareholder value. Strategic moves like the Marathon Oil acquisition bolster this outlook. While macroeconomic risks persist in energy, the company's focus on capital returns and resilience may present value opportunities for growth-focused investors. ConocoPhillips' net income score trails both industry peers and the broader market, highlighting challenges in profitability. Its EPS marginally surpasses the industry average, but falls short of the S&P 500, indicating earnings per share are not as competitive, signaling areas needing improvement. ConocoPhillips' price-to-earnings ratio of 12.74 and price-to-book ratio of 2.83 position it favorably among peers. Its PE ratio is higher than Diamondback Energy's 8.88, but significantly lower than Hess's 31.91, indicating a reasonable market valuation relative to earnings. This suggests potential undervaluation, especially considering the upcoming integration of Marathon Oil, which is expected to boost production and market position. Management's plans for share repurchases reflect confidence in achieving competitive returns and aligning with shareholder interests, highlighting opportunities for enhanced future profitability. According to our proprietary Bow score, ConocoPhillips has higher PE and PB ratios than most industry peers, but lower than the majority of S&P 500 companies, suggesting it is relatively overvalued in its sector, but undervalued compared to the broader market. According to our DCF analysis, ConocoPhillips' equity value per share could reach $253.61 by 2028 under optimistic growth. This reflects expected revenue increases to $181.35 billion and capital expenditures of about $32.45 billion, supporting growth amid price recovery. A historical operating cash flow margin of 33.46% shows strong cash generation despite economic fluctuations, a positive sign of financial health. Scenario analysis highlights how changes in free cash flows and growth rates impact equity value. Management's balanced investment approach aims to optimize shareholder value during acquisition integration. ConocoPhillips achieves a DCF score surpassing 82% of industry peers and 92% of S&P 500 firms, reflecting robust intrinsic value. This strong performance suggests the stock may be undervalued, presenting a promising opportunity for value investors seeking quality in the energy sector. Analysts' average price target of $140 for ConocoPhillips indicates confidence after the Marathon Oil acquisition. Stock prices rose from $104.55 to $124.70, reflecting optimism. Management warns of macroeconomic risks, but solid cash flow and strategic investments may strengthen its position. ConocoPhillips' strong analyst target BOW score better than 71% of industry peers and 89% of S&P 500 companies highlights significant analyst optimism, suggesting the company is well positioned for future growth in both industry and market contexts. ConocoPhillips presents a compelling opportunity for value investors. Despite facing declining revenues due to fluctuating commodity prices, the company exhibits strong operational efficiency with improved gross and operating margins. The strategic acquisition of Marathon Oil is poised to enhance production capacity and unlock $1 billion in synergies, strengthening its market position. A prudent debt-to-equity ratio of 0.2 and robust free cash flow underscore financial resilience. Management's commitment to a $20 billion share repurchase plan signals confidence in future profitability. With analysts forecasting growth and a DCF analysis indicating potential undervaluation, ConocoPhillips is well positioned for significant growth ahead. Make sure to watch another video from our Value Explorer series by clicking the playlist below.